AHP Servicing, and today we're going to talk about financing non-performing mortgages. This is something that we have come up with over the last short period of time. In the last year, hold on, I just lost my screen. There we go. It's something that we've been working on for a couple of years, but it's been something that I think has been needed in the industry for many years before that. When we were a fund, and we still are, but when we were a fund before being a servicer, lots of times we'd be looking out for leverage. You know, hey, we have all these loans, we need cash usually to buy more loans, and we had trouble finding sources. Hi, Chris, welcome.
Hi, good morning.
Welcome. Good morning.
Good afternoon.
Yeah, so welcome Chris Pummill, who's the president of preREO, who is also joining us for this presentation. But the goal here is for those of you who are buying non-performing loans, for those of you who are selling non-performing loans, for those of you who already have non-performing loans and need cash in order to acquire more. This webinar should help all of you. So we will get started. So here's how this works. You, as the loan purchaser or the loan, if you're buying loans, then you will put down 25%. We will finance 75%. And now if you already own loans and you're looking to cash out, then we can loan you up to 75% of property value or 67.5% of the total recoverable debt, whichever is lower. And that is, so it can be a significant amount of your purchases. You know, if you have to pay cash for every deal and you have 100 grand, you're going to buy, you know, whatever 100 grand buys. But if you use that 100 down and we can provide you financing, then you could buy, you know, 4 times as many. It's easy math to do, but it's something that is, has been historically very uncommon in the non-performing note world, and I think the biggest challenge has always been how does a lender secure their interest in a non-performing mortgage? And I think that's what it boils down to. The larger, you know, if you own 50 million, 100 million or more, then you can go to institutional investors who will often provide financing, and they put the loans typically in a trust, and then they can create either issue certificates or find ways that if there's a default, then the lender has the ability to intervene and protect themselves. But when it's just one loan, it has always been historically difficult to do. One loan, 10 loans, even 100 loans. So that is why we took the solution that the big institutions use and found a way to use it for non-institutions who are buying, you know, one or a handful or 10 dozens or even hundreds of loans. What we've done is we have the loans assigned. So if you're financing a loan with us, the loan will be sold into or transferred into U.S. Bank Trust, NA, as trustee for preREO Trust. So the loan will go into the trust, and then the note owner will receive a participation interest in that particular asset or assets that are deposited into the trust. And then you're provided delegated authority to manage the asset, as well as all the economic benefits beyond repayment of the financing. And so that is, I think, the key differentiator from past attempts to find means to finance a non-performing loan or loans is simply having the holding vehicle hold them, give the mortgage holder delegated authority. So that, what does that mean? That means that you, if you were obtaining financing, would decide, you know, do we accept this mod proposal? How much do we bid at foreclosure sale? Oh, it got foreclosed upon. Do we fix it up? Do we sell it as is? Do we sell the loan? All these decisions are decisions that you as the mortgage holder get to make, and then instruct the trust. Here's a loan sale agreement because we're selling this loan. I want you to sign it. We'll go ahead. It'll go ahead and get signed. Here's a listing agreement because we want to list the REO. All those things are things that are done at your direction. So you're going to manage the asset just as you would any other, and hey, foreclosed, go ahead and proceed with foreclosure. Go ahead and, hey, the homeowner's expressed interest in a deed in lieu. Go ahead and say yes, no. You get to decide how much the cash for keys amount is. So all these are generally situations where the servicer will come back to you and say, hey, here's what's the option or options that have come up. Which do you want to do? And then you reply from there. And again, all the economic benefits beyond repayment of the financing go to you as the participant. So, there's if you make a lot, if you make a little, if you lose money, those are all at since you're the one managing it, you reap the rewards or experience the losses depending on the decisions that you make. The big benefit or an additional big benefit to having the loans held in a trust with a national bank trustee is now you have a compliant holding vehicle. I know there's many smaller investors who are holding their loans in an LLC or limited partnership or something like that, or maybe once in a while I see even a private party that owns a loan and records it in their name. All of those can be okay, except there's about half the states of the union who say that's not okay. That if you own a mortgage secured by a property in their state, you need to have a license, and sometimes it's gone beyond because some states will say, okay, well, you have a licensed servicer who is servicing this loan, so you're okay. But in some states, and notably Pennsylvania and Georgia have been the most aggressive in enforcing this, but they're saying that no, if it's serviced by a licensed servicer, that isn't enough. Whoever actually is vested and holds that mortgage needs to be licensed. And the solution to that, if you're not looking to get a license, is to have it in a trust with a national bank trustee, because that is exempt from those state law requirements because of the national bank's involvement. So kind of kill two birds with one stone. And those are two important birds to kill. The fines being levied in Pennsylvania are significant, and in Georgia, they're actually fining the sellers of mortgages who sell to mortgage investors who are not properly licensed. So they justify that by saying the seller should have done the due diligence to make sure that whoever's buying these loans can hold them, are licensed to hold them in Georgia. So this, as a result, we're now seeing tapes that are going around saying, hey, if in order to buy the Georgia tapes or I'm sorry, buy the Georgia assets, you need to be in a licensed entity or in a vehicle that is exempt from licensure, which is the case here.
George, just a comment I wanted to make on that.
Please.
George talked a little bit about, that delegated authority and how you become a decision maker. Just to let everybody know, the preREO team is in tune, in touch with that servicer, and also at the time of should it go into default, should you need assistance in getting that note going down the foreclosure track, we have access to all those things. So the preREO team is working as your partner to kind of make sure that everything along the way, should it go in default, is being monitored, you're being communicated to, and assisting with some of those managing those milestones for you. So just a couple of notes about, we don't expect you to just go off on your own. Of course, you can choose other firms, but we want to help and make sure that everybody's informed and keeping in communication on those items.
Hey, I appreciate you bringing that up, Chris, and sharing. I will, that segues nice. I skipped a slide and I'll go back, but it segues nice into this slide. So if you finance through us, and we're providing 75% of the money, we need to make sure that we get our money back. So what we do is we require that the servicing is done by AHP Servicing, and the foreclosure work or any legal bankruptcy, anything like that, is handled by either America's Trustee Services, which is in the non-judicial foreclosure states, or Activist Legal, which is in the judicial foreclosure states. So you So we do choose who you're going to use for the servicer and the legal, just again, so we maintain control over the money. And I believe there's a provision in there that if you really wanted to choose your own law firm, you can do that, but you have to put a greater amount down. I think it's 50% down. And then you can't choose a servicer still, but you can choose the law firm as long as they have experience doing foreclosures. Okay, let's jump back real quick. So the terms, what do you pay for this? Here it is. It's 12% interest. It's payable monthly. 3 points paid up front, which will be a minimum of $1,500. So think about that when you close. You're buying a note for $100,000. You need to wire the seller $100,000. You're going to wire us the $25,000 plus the fee. It'd be $3,000 in this case. So you're going to wire us $28,000. We're going to take 25 of your 28. We're going to take our 75 and going to wire that to the seller. And so now the seller, the transaction is closed and the note is sold. And that mortgage sale agreement isn't going to have your name on it or your LLC. It could at the initial, but by the time we're ready to close and fund, it needs to have this entity, U.S. Bank Trust, NA as trustee for preREO Trust. And that was what will be on the purchase agreement. And most sellers, again, this is an entity that's exempt for licensure and something where it should make it very easy for the KYC or any of the sellers who may have concerns about, does the buyer have a license? Okay, now back to this slide. So 12% interest only, 3 points with a $1,500 minimum, no prepayment penalty. So the loan's for up to 3 years, but if you decide to sell the loan early, if it forecloses and you sell the property, then any situation you can pay the loan off early. The mortgage and a question that often comes up, which I should have probably put on here to trigger my response, is what happens when the foreclosure is complete and now it is being held and maybe you're selling it right away, or maybe you're rehabbing it and then reselling it. Can you keep the existing financing even though it went from a loan to an REO? And the answer is yes, you can. As long as it remains vested in the trust, the financing can remain outstanding. Now it's 12%, and once it's an REO, you may be able to find less costly financing. But I guess if you're only holding it for a few to several months, then probably the cost of the additional financing aren't worth it. But if you're holding it for an extended period of time, then you definitely want to consider refinancing to pay that off, or obviously a sale or anything like that would pay off that financing. The questions, and just to reiterate, because this question comes up a lot, when it becomes REO, who signs the listing agreement, who signs the sale agreement, who's on the HUD at closing? And it's U.S. Bank Trust as NA as trustee for preREO Trust. But we are going to, once that loan sale, once that REO sale is completed, or payoff, any of those things happen, then the financing amount is paid off, and the balance is wired to you. So where can we do this? We can do this in every state of the union. So all 50 states, plus District of Columbia, plus Puerto Rico. We've done Hawaii, we can do Alaska. Really, we can do any state. So no matter where it is, we can assist. And there's no minimum loan size. You can do 1 loan, you can do 100 loans, you can do 3 loans, whatever's, or more. Whatever you have, we'd like to help. And those loan sizes could be, we don't have a minimum, like it has to be 100,000 balance or whatnot. If you have a loan with a 10 or 20 or $30,000 balance, we're more than happy to include that, to finance that for you, regardless of the value. So those are key. I'm trying to think. We've done some. Most of what we've done are like one to a handful. We have had a couple of groups who are buying maybe 10 or 20 that have come to us for financing, and we want more. We want to see what we can do with 100 or more. So it's not going to strain our capacity. In fact, it helps our capacity. The more loans we bring in, the greater steps we go towards establishing a very large institutional partner, which will make this all a lot more streamlined and scalable. But right now, we need to demonstrate that volume. to bring them aboard. So they're on the sidelines ready to go.
And just a side note, we do have other note sellers who don't have the financing. So there's a lot of that kind of interest too, more recently. So just a little note that there are others that are interested in this as well, as far as the financing goes.
Yeah, I appreciate you bringing that up, Chris, because there are sellers, if you're buying a loan, so we run a platform called preREO, which is a marketplace where sellers, institutional sellers, sell their mortgages to real estate investors typically. And but if some of those buyers have found loans elsewhere, Condor sells loans direct, Oak Harbor sells loans direct, so there's others out there, and they've taken those loans and brought them up to us in order to finance them. So we're more than happy to do that. But I think what Chris is saying is particularly important, because put yourselves now, instead of a buyer looking for financing, put yourselves in the shoes of a seller who's now looking to sell the note. And a great time if you're a seller to help spread the word about the financing, because if an investor comes to you and they have $100,000 and your loan is $100,000 or the purchase price is, then they're going to buy one loan. If they can finance them, now they can buy 4 loans. It increases execution and the scalability of your sales. So please keep us in mind if you're selling loans as well as when you're buying. Here's the processing. We made it as easy as possible. When we ask that everybody who is expected to need financing go to our portal and complete the application, and the application needs to be updated once a year. If you do a loan today, a loan in a month, and 6 loans in 3 months, and 42 loans in 8 months, you only need to do that application once. This is going to include your personal information, your financials. It's going to include a credit check. It's going to include a know your customer check. But I want to remind that this is, even though we're getting credit checks, and the reason is because we are working with institutional partners, and for them, some of them have minimum credit scores. They may say, hey, I'm interested in participating in these financings, but only for those borrowers who have credit scores over a certain minimum. Now, we also supplement this with crowdfunding. So if any of the financings that come through are not agreeable to any of our institutional investors, then we can go ahead and fund that out of the crowdfunding money. So the crowdfunding money participates in all the loans, and then they also participate in, and they may have a full participation if for whatever reason the institution's the institutional criteria does not overlay with any particular borrower's request. It also could be an on-site, a difficult type, not a difficult, but a more unique property size. Like if someone brought us a church, the first mortgage on a church to get financing, the answer is we would probably finance it. Again, it's probably non-performing, and our institutional partners may say we're not going to participate in that, which is fine. We can still fund it. So 2 things, if you need to get started, you complete our application, all done online, and then you go through the first couple of steps where information is gathered from you, and then you're going to get a pop-up saying, hey, your information is being reviewed. We're going to review your information and then come back to you and say, hey, usually an email notification, hey, you're qualified and ready to go. Most of this is know your customer at this point, just to make sure that you're a real person or a person representing a real person representing an entity. And then we go to due diligence. If you can complete the application today, even though you are still on the hunt for a loan, but once you've identified a loan, whether it's right away or whether it's some point in the future, and you need, we enter due diligence. And basically, this is where the loans that you're trying to purchase, if you've already done the due diligence, we're going to ask you to share that with us, and we will utilize as much as possible of it. If you have a recent BPO, a recent title report, and you have a third party that's completed a collateral review and a review of the legal file, all those things, we can probably use them. If there's anything we're missing, like, hey, you don't have a recent title report, we're going to order one, and we will charge you for that. But we'll just pass through whatever the cost is on an a la carte basis. And so once we review your due diligence and or supplement it with our own due diligence, we will then confirm that yes, we can proceed. And in almost all cases, the financing is predictable in amount. And I'll just go back to that slide just so you can see, if the property value, if the home's underwater, if the family owes more than the property is worth, then we will fund 75% of the property value. And if your loan has equity, or the loan you're purchasing has equity, then we're going to finance up to 67.5% of the total recoverable debt. And in either case, we're financing the lower of the two. And so that when you go through the due diligence and the qualification process, where the goal is not to say, oh, on this one we'll do 50 because it's rural, on this one we'll do 65 because it's in a suburban area, and these others make it unpredictable. So we can stick to those numbers unless it's some extreme situation. And why is that? Why can we be flexible and maybe not having why is this? If we can be flexible with the financing, here's why. If our underwriting is right and your underwriting is right, and we're buying this at a significant discount, and then you're putting down 25%, we feel that we're going to be in on average about 56% loan to value. So, or I should say financing to value. So if a home is worth $200,000, then let's say you're acquiring it for $150,000, and from that, and actually I just realized that I may have misstated this. It's 75% of 75% of property value. So let me I have to correct this slide. So if you're buying, and I'll walk through an example just to make sure everybody's clear, including me on this. So if the property value is $200,000, and let's assume you're buying it for 75% of property value or less, so you're buying it for $150,000, we will finance 75% of your acquisition price, which is going to be, in this case, $112,500. So now back to answering the question of why can we be flexible? It's because there's already a discount. You're putting down 25%. And we're into there probably on average about 56% loan to value, and on the loans that have equity will be even less. So we feel comfortable that that's sufficient equity to protect our interests. And what happens? What's the worst case scenario if somebody doesn't pay? If somebody does not pay, then the participation interest is at risk of being forfeited. So if you put down the 25% and a year later, you decide I'm not going to pay on the loan, then we would forfeit the interest. You'd be notified, and you'd have a 30-day notice to cure and correct the situation, which is mostly usually making payments. And if that didn't happen, then the interest will be forfeited at the end of that time, and you'd receive a note that your interest has been forfeited. That's only happened once, and we've done hundreds of these, and it's only happened once, and it was in a situation where the loan was purchased for 16. The bar had put down 4, and they disappeared. And it was kind of early on in COVID. We don't know if something happened, I hope not, to the bar, but either way, they never returned our calls, and we forfeited their interest. So we've gone down the procedure, but generally, in our experience, we have not had to even have that as part of the discussion, because most of the time, people putting down 25% are interested in maintaining their interest. Okay, so if you were saying, okay, I'm ready to go, I want to get financed, what do? You can go to preREO.com. In fact, go to finance.preREO.com /register, and you can begin. And here's the screen you're going to look. You're going to look at a portion where you can create an account, and you can enter your email and password or create in order to get started. Now that is. Then you'll be walked through, hey, I need to know your current annual income. I need to know some information on your net worth. We need to run your credit, run your customer check. And with that, you're going to review, and you'll be notified that you're in review, and it'll be promptly reviewed, and we'll get back to you and say, hey, you're ready to go. and proceed with financing. And now you will, if you already have a loan or loans that you've identified that you want to purchase, you can log back into the site, upload the BPO, the title report, whatever else you have, collateral file, and for our review. If everything's recent and it all checks out, then we're ready to fund. If there's a but if sometimes you don't have a title report, or the title report you have is a 1.5 years old, we're going to need to order a new one. We'll let you know. Here's what we can use. Here's what we need to update, and then you can decide whether you want to proceed. And that's the presentation. Chris, what did I leave out that would be helpful?
A couple of notes on the due diligence piece. George mentioned earlier. Some buyers don't have a preferred vendor or that option. So if you need our assistance, we do.
Yeah.
We can order that for you and help to get that to you. The fee that is charged is only charged to you if this deal closes. It's an all-in-one, very comprehensive due diligence process, so due diligence and updated title and the whole thing. So that is available. And again, you would only pay if in fact the deal closes. If something popped up there, it would be no charge to you. So just wanted to mention that we do have a primary vendor that we're working with to complete that, and we are, we have access to their system, and it's very easy for us to order for you. So keep that in mind if you need that.
Yeah, I appreciate that, Chris. Let me add a little bit of detail to that. So we use a third-party vendor. If you have no due diligence done, we can order the due diligence for you, and the charge is $500. And it'll be start to finish. It'll be BPO title report. It will include a review of the collateral file, a review of the legal, the status of the foreclosure, statute of limitations check, just about everything that you'd want to have done to protect your interest and to protect our interest. So that's one. Now, if you're buying the note on the preREO platform, and we'll front the due diligence, and if you don't use it, just like Chris said, then if you don't close for any reason, then we're not going to charge you for the due diligence. It's only paid if you close, and again, it's $500. Now, if you're bringing us a loan that you found in the open market that has nothing to do with the preREO platform, we will do the same thing if you like. We can do all the due diligence, or if you're missing some things, it can be a la carte due diligence. But on those, if you don't close, you pay. You will reimburse us just to pass through for the due diligence. Here's why. If it's on preREO, then and you decide you win the bid, you go through due diligence, and at the end you said, hey, I'm not going to buy this. That's fine. And then you're not charged for the due diligence. But now, since it's on the preREO platform, the next buyer, we can use that same due diligence for. So it actually is helpful for that. But not the case if you're buying it from, let's say, Condor or someone like that, and we're not the marketplace for it as well. Hopefully that helps. And I'll throw it back, Chris. Any other observations or questions? And then I throw it to the audience also for any questions. And actually, I see a few here. Let me pull those up. Okay. So anything else, Chris, on your side?
No, we don't have a whole lot of time, so we'll leave it to the audience so we can get their questions first.
Yeah, from Chad, did you mention at the beginning that we could refi out of existing MPL? The answer to that is yes. So we will, if you currently hold the mortgage and want to cash out, then we can review those to cash out. And we have no problem doing it. Again, we're going to due diligence it just like we're buying a loan, because in a sense we are. We're participating in it with you. And if the numbers all make sense, then we're going to finance up to 75% of 75% of the property value, and if there's equity, then 67.5%. So yes, you heard that right, Chad. From Freddie, hey guys, do you work with nonprofits? Sure, with reverse mortgages, HECMs, I think is probably what you're referring to, Freddie, and the answer is absolutely yes. So if you work with a nonprofit who owns or is acquiring HECMs and needs financing, please reach out. We'd love to work with you. Wow, and it's on the money, 12:30. Congratulations, Chris. That was pretty good. Perfect on time. So any last questions? If not, that was hopefully a productive 30 minutes. You learned what we're doing, and reach out. You know, if you're interested in this product, it's offered through an affiliate of AHP Servicing, which is preREO. Chris is the president of preREO. You can reach out to preREO at 800-555-1055. You can also go to their website and contact them through there. But please reach out if there's any other questions or you have a deal ready to go. If you have a deal ready to go and you're at the point where saying, hey, I'm ready to start this, or even if you don't have a deal ready to go, on the screen you can see finance.prereo.com. You can go and create an account. That will get you started. There's no charge or anything like that for us to run the credit and get you set up and be ready to buy deals. So I appreciate everyone joining today. Hopefully you learned something that's valuable, and we can look forward to financing some of your NPL purchases. All right, thanks everybody. Thanks, Chris. We'll see you next week.
Thank you for your time today, everyone. Bye-bye.
All right, bye.